Hey there, everyone. Welcome to Chart This with Dave Keller. I'm your host, Dave Keller, coming to you live here on Wednesday, December 11th, just after the close here around 5 p.m. Eastern, coming to you from a beautifully clear Redmond, Washington. Speaking of beautifully clear market trends, the S&P and the NASDAQ certainly seeming to represent that quite well. We're seeing a nice uptrend in the major averages continue today. The CPI number before the open today coming in basically in line with expectations. That is juicing another push higher. And it's not just in equities. We're seeing rally in cryptocurrencies as Bitcoin gets back above the 100,000 level. We're seeing the FANG sectors at the top of the list, far outpacing pretty much everything else. Continuing, honestly, the theme we've been sort of hitting on through the course of this week, which is, and really through the month of December, right? Deteriorating breadth as the market goes higher. So market strength is basically defined by the indexes. The strength in the indexes is not defined by the average stock. It's defined by the biggest names. The FANG stocks are the Magnificent Seven. Those are the ones doing the lion's share of the gains here. As a result, it's one of those narrow rallies. Now the market has had sustained moves, sustained bullish trends with narrow leadership, but it usually doesn't end well. And I think that's the thing that I have in the back of my mind, right? I was taught when the market's going higher on weaker breadth, you want to be skeptical. The question is how strong the FANG sectors or the FANG stocks can be. Today, what we're going to do is look at the major averages. We'll talk about the general market conditions, look, of course, at the market carpet heat map. And then we're going to focus on the charts. And we're actually going to go through each of the Magnificent Seven and friends. So 8 stocks altogether that I'll go through and really group them into 3 kind of key buckets. We have the stocks that are in strong uptrends that are just long and strong up and to the right. We have some of those things like a Meta or like an Alphabet just starting to break out. And then we'll talk about some of the others like a Microsoft or an NVIDIA, and just try to hit on key levels and patterns to think about with those 3 different buckets, which I would say are kind of unique. As much as we think of the FANG stocks or the Magnificent Seven as a bucket of stocks, they're actually in 3 kind of distinct groups at the moment. And so I'll share with you why I think that and what we should be watching. All right, with that in mind, let's get to the market recap and focus on how things played out through the course of the day today. The S&P 500 up 0.8%. Nice up day, finishing the day just around 60.84. Looked like it might be pushing above 6,100 around the lunchtime hour, but the rally in the morning kind of stalled out. We pushed down a little bit further going into the close. The NASDAQ composite far outpacing pretty much everything else, up 1.8%, a little bit more for the NASDAQ 100. That pushes the NASDAQ composite above 20,000. Mid caps and small caps all in the green, but the S&P and then really the NASDAQ outperformed all of them. The Dow, the only thing down today. So it shows you, as we mentioned earlier, I think this was earlier this week, if I remember right, we were talking about the construction of the Dow versus the S&P and the NASDAQ. The Dow just has more non-growthy stuff in there. So when growth is dominating, the Dow is going to underperform the other major indexes. The VIX moving back down about 0.6 VIX points to right around 13.5. So we remain in a low volatility uptrend. Honestly, I mean, as I'm reflecting on the charts here and as we get to the chart of the S&P and other major averages, I mean, I'm not surprised, right? When you think about the seasonal tendencies in November and December, most election years, once the election is completed, and particularly when there's a contested election and it's unclear what the next, who the next president will be, once there's stability, whether or not we think it's unstable in terms of policy decisions and who's in office, that has nothing to do with it. The market does not like uncertainty. It likes certainty. So once we kind of know who the next president is going to be, and then it's all about thinking about those expectations, the market tends to move higher. Now, Q1 of a post-election year is a different story. And I think that is what we will be working on together going into the beginning of next year. I hope you come along the ride with us here with Chart This. All right, let's get to the interest rate environment. Rates going higher as bonds sold off today. So sort of a stocks up, bonds down kind of day. The TLT, which is a treasury bond ETF, was down about 1%. The 10-year treasury yield moving slightly higher. Finished today around 4.27. The long bond yield just below 4.5%, and the 5-year point right around 4, we'll call it 413. So rates are going higher here today. And I think that's an important thing to watch. We have a chart of the 10-year yield that I grabbed for our chart review. But I think one of the key themes, I mean, as much as we talk about day-to-day movements on a show like this, for me, it's all about connecting what we saw today with the bigger picture, right? What are sort of those larger themes that we are observing, and what incrementally changed today? What can we do to add to that thesis based on the evidence that we're gathering? And one of the key themes I think we will be dealing with going into next year, if not for much of next year, will be a steepening yield curve. We've had an inverted yield curve for a number of years. We're now getting back to a normal shape, and the Fed bringing the lower end down, which it looks like they will most likely do yet again next week. And if long yields remain stable or slightly higher, that's going to give a natural sort of upward slope to the yield curve. That is tends to be good for certain areas of the market, particularly financials, particularly small caps. And so I think that's one of those themes to certainly pay attention to. That's why even if you don't trade bonds a whole lot or think a lot about the interest rate environment, I feel like most of us do at this point just because of the Fed and what all has happened. But I would encourage you to pay attention, particularly the shape of the yield curve, which is so important. Looking at the commodity space, most pretty positive day. Gold actually higher, about 1%. The GLD finished just above 250. Silver price is slightly higher. Copper slightly lower. Energy actually had a decent up day, as did natural gas. The USO, which is a crude oil ETF, finished up about 2.7%. Natural gas price is about 5% higher. That's using the UNG. Bitcoin kind of pushing to new highs as we speak here. It's just below 102,000. Not too long ago, in the last 48 hours, I'm fielding questions about whether we're going to see 100,000 again. I'm getting asked about downside objectives. And my general thesis is the long-term trend in Bitcoin and Ether prices are pretty good. It's all about tactical pullbacks and sort of tracking those. And I think differentiating the short-term movements, the short-term fluctuations with the longer-term trends is so vital. By the way, just dropped the latest episode of our Market Misbehavior podcast. I spoke with T.G. Watkins of Simpler Trading yesterday on Tuesday. Just uploaded that video about an hour ago, so I'd encourage you to check it out on our YouTube channel. Really cool conversation about a number of things, a little more short-term oriented, a lot about momentum trading and breakouts. But the reason why it came to mind here was we talked about the multiple time frame sort of challenge for traders and investors, thinking about 15-minute and hourly charts, but also daily and weekly and monthly charts, and how often a short-term signal tends to arrive first before the medium-term and long-term signals are kind of triggered. I'll leave it there, but please check out that interview. It's a lot of fun. Some really interesting thoughts by T.G. Watkins of Simpler Trading. All right, looking at the 11 S&P sectors, kind of a mixed day, to be honest with you, although I think the real story is the dominance of these three top sectors: consumer discretionary, communication services, technology, all up about 1.5% to 2% to the upside. So there is your story, right? I mean, as much as we think CPI came out, the market liked it, three sectors really liked it, and it's the growth sectors that have continued to dominate for much of 2024, and today sort of continuing that theme of mega cap growth domination. The only thing I will say about this is at some point that probably changes, and I think looking at conditions with other sectors, looking at relative performance especially, can be so helpful about recognizing potential leadership shifts. I think we're going to be on we're on the verge of another one of those big leadership shifts. We've experienced that a couple times in 2024. Remember, earlier in the year, it was the Magnificent Seven over everything. That was like Q1. And then all of a sudden it turned into other things like energy, financials, industrials, materials. Sort of the cyclical sectors did quite well going into the spring. All of a sudden the summer hits and it's defensive sectors like utilities starting to outperform. Now we're back to the Magnificent Seven. I feel like we're kind of rinsing and repeating that natural cycle of leadership. Certainly going into the new year, that is often when you get some changes. But for today, more of the same. Mega cap growth over everything. Those are your top three leaders. Financials and energy, for the record, did finish slightly above zero. Everything else was down. And healthcare, the worst performer, down 1.4%, followed by consumer staples and then utilities. Again, it's early days, so let's just chill out with the general takeaways here. But as a reminder, my market trend model, I update it every Friday after the close. During the week, on stock charts. They very kindly programmed this in as a dashboard little widget so we can track these during the day. It does a quick check after the close every day to see if there are any updates. It's not a formal change in the model, in my opinion, until Friday at the close. That's kind of important to patiently wait for all the week's action to subside, and then after the close on Friday, make an assessment about what sort of changed and what might be new or different. For what it's worth, if today was the end of the week, the mid-cap model would turn negative on the short term. These have been lights out, all green for a number of weeks now, really coming off of weakness in July, August, September period. We're going to dig into the Magnificent Seven, and that's because charts like Tesla are up about 6% today. Alphabet up 5.5% today. That's after another big day earlier in the week, kind of continuing to move higher. NVIDIA, third on the list, and it's still up over 3%. Apple's the only one that was down today, down about 0.5%, but the Mag 7 stocks had a decent go of things here today. Let us get to the market carpet. This is a heat map style visualization. I love things like this because it gives you so much information in one kind of nice, tidy visualization. This is why I love the RRG as a way of thinking about sector rotation, and why I like this one, looking at the heat map style visualization, just understanding a lot of individual stocks and how they roll up into the major averages. Three things we do with this one. We'll start with number one, general impressions looking at the chart. I mean, there's a clear differentiation in my mind, and I feel like you can almost draw a kind of semi-vertical line there, separating the haves and the have-nots, or the obviously strong versus the obviously not so strong. The left half, which includes the growth sectors like tech, communication services, discretionary, quite green. On the right side, we have some of the cyclical and defensive sectors like healthcare, like industrials, like staples. It's actually interesting just today, and I just noticed this as I was preparing for the show. Financials have been down here, and they actually just switched. And I don't know if that was an automated thing. I forget how this was designed. I don't know if that was automated based on the market cap. And because communication services is a big enough one, it actually put it over here. I'm not sure if that's true, but I think it might be. And if not, it certainly is more helpful to group the growth sectors like this and then kind of group financials with the rest of the cyclical sectors over on the right. So nice improvement. In case it looks, for me, I immediately look down. I'm like, why is Alphabet down there? It's because they switch spots here. So having said that, the strength in the growth sectors clear. The weakness, not just the lack of participation, but the flat out weakness in other areas of the market today is telling, right? So, again, I think you see the top sort of headline number, NASDAQ up 1.5%, 2%, whatever it ends up being. This is the story, I would argue, which is a relatively small number of growthy sectors did great. A bunch of other stuff was actually kind of in pullback mode. And that's been the story here in the month of December. Now, I mean, as we mentioned earlier, that theme kind of persists until it stops, and it ends one of two ways. Either the growthy stuff that's so bright green today is sort of the last safe haven, and then when that fails, kind of everything's going down in a major way. That's your bear scenario going into January. Or the strength in the Magnificent Seven is enough that it allows these other stocks to kind of pull back. And then investors go back risk on into these other areas once they realize the world's not going to end. That's more what happened in like January, February of this year. I don't know exactly which one of those is going to happen. I do know I'm going to follow the charts very quickly to make that assessment. All right, question two, the big dogs, as I mentioned, they're all up a ton, save Apple, which was actually down today. Most of the biggest names, including other kind of big names like Broadcom, even semiconductors, which have been absolute dogs recently, like Micron, like LRCX, like Skyworks, on Intuit, other software names, all bright green today. So I think you're seeing quite a rotation, further rotation, at least today, into the growthy stuff. Finally, some opportunistic things. I'm looking down at the consumer space, things like Nike, which have not been particularly good charts. Still, I think much more to prove before that looks like an attractive chart. But we are coming off a higher low in November, and I think that might be kind of interesting. Cruise lines, we talked about Norwegian actually, making a new high and then breaking down to almost a new swing low. It's sort of consolidating, very much like NVIDIA. Might be an interesting one to watch to see if we get that upside follow through. Also, Ulta, which is an earnings name here over the last week, actually rotating back to the upside. Thanks, someone, for mentioning Nike with the NFL contract. I had not seen that. I appreciate you pointing that out. I'll dig into that a little more after the show. Other thing I would notice, I mean, healthcare, hopefully you've not picked up on me saying anything about healthcare being a great opportunity generally. There have been random moments where individual names look good, but healthcare has been an underwhelming sector here for quite some time. This is sort of the forgotten sector of 2024. I feel like other things have come in and out of favor. Healthcare has been just kind of consistently not great. And so it's more opportunistic. There are individual names within there that can have some constructive patterns, but a lot of these are breaking down in a pretty big way. United Healthcare, obviously, tied up with the incident in New York and all of the fallout related to that. But from a technical perspective, which is where I prefer to focus my attention, at least here, breaking down below 550, making a new 3-month low. That's not great when that is happening on charts that you're caring about. All right, we're going to continue on with the chart review. I do want to let you know I meant to have this really beautiful graphic. I don't know if I can actually make that happen without completely disrupting things. I'm going to give myself about 8 seconds. So we count down. Let's see. Can I make it happen? I think so. There we go. I did it. All right. Did want to let you know we have our next webcast coming up on Tuesday, the 17th. You can sign up for that free event that's coming up on Tuesday at 1 p.m. Eastern. Go to marketmisbehavior.com/reflections or scan the QR code that you see kind of right over my shirt on the graphic here. We are going to do an exercise that we've done a couple of years here in recent history, which is ask 10 questions. This is something I've done every year for years. The 10 questions really hit on performance. It hits on process. It hits on lessons learned. These are 10 questions that I like to ask myself. During the broadcast, I will share with you the 10 questions. I will answer them live in front of all of you. And I would encourage you, I will give you a cheat sheet with those 10 questions. And I would encourage you to spend some time between then and year end to answer the questions for yourself. I promise if you take the time to do that, at least something good will come out of that. It will help you think about how you think about the markets, help you really focus on what your experience has been in 2024. And I hope set you up for success in 2025. So again, that's coming up next Tuesday, the 17th at 1 p.m. It should be a lot of fun, and I hope you can join me. It's called Trading Reflections, 10 questions mindful investors ask at year end. And again, you can sign up at marketmisbehavior.com/reflections. All right, let's go to a daily chart of the S&P 500. No real change here. I mean, the general trend remains consistent. And, this is one of those funny things about doing a daily market recap show. By nature, I am more of a medium-term, long-term investor. My most important investment decisions are made over the weekend when I do a weekly process that culminates in a report that I give to my premium members called the Weekly Flight Plan. Those are my main takeaways. That's literally, what have I learned? Where am I at? What am I looking for? And then every day on a day like today, it's really to incrementally add to what I thought about over the weekend. So every day it's just what changed, what's different, anything new, anything, evolving from what we saw when we did the deep dive when the market was closed. And I would say for now, not really, right? The last 2 days have certainly been a pullback days on Monday and Tuesday. Today, bouncing back higher, of course, when the CPI comes in, basically in line with expectations was the word I was going for. And what's so funny about that, by the way, is that, CPI, the inflation data, is still above the Fed's bogey, right? 2% year over year is what I was told they were definitely looking for. We're still not there. So we're where we expected, but it's still above that bogey, which for the record probably implies further rate cuts are probably happening and et cetera, et cetera. But the challenge is, as always, right, we are assuming that inflation does not creep back up. It did not creep back up, at least any more than was expected. And so that's why the market took that as a positive win. And again, not the entire market, but the growth sectors took that as a pretty good win. For the record, S&P closing around 60.84. Same thing we've talked about. I generally would say anything above 58.50 for me is kind of noise. Tradable, yes. Swing trades, yes. Mean reversion for sure. But a dramatic change in the primary trend, not for me until we get below 58.50. We're not there today. Shout out to a good friend and someone I've known for, we talked about earlier today, probably over 20 years, Bob Schott. Bob was at GE Asset Management up in Connecticut for many, many years and had a great successful run there. I was catching up with him over a Zoom call earlier today. He reminded me of this chart which he had shared a version of this chart he shared at the TSAA conference earlier this year. That's the Technical Securities Analysts Association, based in San Francisco, is a group founded by Hank Pruden and a couple others a number of years ago, still continuing to this day. And it's a great group of technical analysis oriented folks. And Bob had a chart like this. And his point was, we were talking about, why does the market not feel as good as the charts would suggest, right? The S&P is making new all-time highs. The Nasdaq's making new all-time highs. And this was earlier in the year. Why does it not feel that great? And he brought up a chart of the S&P in terms of gold. You can do that very easily on most platforms by just charting a ratio of the S&P divided by gold. So this is the S&P 500 index divided by the gold continuous contract, or the gold spot basically rate. And when you analyze S&P not in nominal terms, which is the index that we quote, but in real terms, which is the S&P in relation to a hard asset like gold, you can see that the market did indeed peak in kind of 1999 to 2000. And even though the S&P is well above its 2000 highs, as is the Nasdaq, in gold terms, we're way below that. As a matter of fact, we're actually way below the 2021 peak. So what's funny is, if the S&P is doing a certain thing and it feels like it doesn't, or it does not feel to you as good as the chart might suggest, this is why. Now, why does it not feel good? What is this actually telling you? Well, this tells you that basically the index is going up, but because of the devaluation of the US dollar, the S&P basically in dollar terms is not as impressive as you think. And in real terms, in terms of the actual buying power of your S&P investment, we're way below where we were in 2000. This is why it feels like things are more expensive than they need to be. This is why it feels like, the markets are at new all-time highs, but things are not as, go easy going as you feel like they should be. This is the chart that tells that story very, very well. So shout out to Bob, who, really shared this with the group. And he reminded me of that chart. Wanted to share with all of you today. All right, a couple other charts, then we'll look at the Magnificent Seven in detail, one by one, actually kind of quickly for time purposes. Interest rates, the 10-year yield popped higher today. The TNX, or $TNX on stock charts, finding support around the 200-day moving average so far in the month of December. A pop higher in yields most likely sort of continues that process of normalizing the yield curve. I mentioned that earlier when we were looking at today's movement in the bond markets. And I would say that if the 10-year yield just remains at current levels or pushes a little bit higher, maybe back up to 4.5, which is where we were in mid-November, and the Fed lowers rates next week, which seems like a likely scenario, that means we're kind of naturally shifting that yield curve to more of a normal shape. Here's the problem. When the yield curve has been inverted for a long time, which it has, and the yield curve comes back to a normal shape, which it looks like it's doing, that usually means not good stuff for equities, at least for a period of time. The long-term trend tends to be just fine, but in the next 3 to 6 months, it's actually kind of choppy results after the normalization of the yield curve. So something we will certainly be tracking going into the beginning of next year. Cryptocurrencies back in on go mode, back on stepping on the accelerator. We can see Bitcoin pushing back above 100,000. What concerns me about Bitcoin, besides the fact that it's just been up a lot, and you expect some sort of pullback at some sort, I would say from a technical perspective, the clear bearish divergence that we're experiencing over the last 4 weeks is concerning to me, right? Back here where we're making new highs and the RSI is overbought, pretty encouraging. When we start to make new highs on weaker momentum, that's where we want to be concerned about the sustainability of the uptrend. Getting above 100,000 and holding there is pretty meaningful. If we do pull back kind of this 90 to 92,000 range, which is that swing low from late November, is kind of that general place I would be looking for some sort of support. The 50-day moving average actually rapidly approaching that level because of the strength that we experienced in October going into November. But for now, long and strong, the price is going higher until it is not. We're going to get to the Magnificent Seven names here in a moment, but before we do, 2 charts that I'm thinking about, and I want you to keep in mind as we're looking at the Magnificent Seven. Even though most of the charts we're about to see are quite bullish, if not very bullish, extremely bullish, the breadth conditions are getting worse in December. The mid-cap AD line actually broke below its 50-day moving average today. The others very close to doing so. The NYSE is kind of right there teasing the 50-day moving average. This tells you that conditions for the average stock are not as good as the Magnificent Seven. We're also seeing an evaporation to new highs. We're not seeing a bunch of stocks doing what some of these charts I'm about to show you are doing, right? Meta making new highs, Netflix making new all-time highs, Tesla making new highs. Remember, those are the outliers in this current market environment. It's not like everything's making new highs, and these are just some of them. Most stocks are actually not making new highs, and we can see that by the fact that there were a ton of new 52-week highs in November. There have been dramatically less in December. Now, you're not seeing a lot of stocks making new 52-week lows. We're just not seeing that upside participation, which usually signals some internal weakness. Now, we've highlighted this chart previously, and I think maybe on yesterday or the day before we included this chart, but just to reiterate, from the August low in the S&P, right? We sort of rallied into June, July, came back to an August low, and then we've essentially rallied from there. And if you start the clock at that August low for the S&P is up about 17.5%. The NASDAQ 100 is up around 22%. The Magnificent 7 ETF, ticker MAGS, is up 40%. So literally over doubling the return of the S&P on a percentage basis off of that August low. The equal weighted S&P is actually trending lower in the month of December. So while the Magnificent 7 are breaking out, the equal weighted S&P is going down, which tells you a lot of other names are not looking quite as strong. I mentioned the 3 buckets out of the Magnificent 7 stocks, and I will tell you the first bucket are the charts just in clear uptrends. These are stocks making higher highs and higher lows. A number of these are overbought, but I don't think of that as a bad thing. I would say this trend is continuing until it doesn't. That's Amazon, that is Netflix, and that is Tesla. And with any of those first 3 names, should we expect pullbacks? Of course, right? In the natural progression of an upswing, you're going to have these pullbacks, right? Stocks just don't go straight up. They go up and then they pull back. They go up and they pull back. That's the natural sort of ebb and flow of price action. Things to keep in mind with that first bucket of stocks, the Amazon, Netflix, Tesla group, is use trend following techniques, right? I would assume that these trends continue until they don't. So you want to use trailing stops of some sort, whether that's a moving average technique, an average to range technique like the chandelier exit, which we mentioned on the show. Those are the kind of things that should help you remain in a winning trade as long as it keeps winning, and then get a clear signal when that is no longer the case. With charts like this in my portfolio, I like to set an automatic alert for when the chandelier exit is triggered. Whether or not that is an automated stop for me, it tells me to revisit it because there may be something to think about, may want to reconsider the long position if and when that stop is triggered. Second bucket of charts, which would be Meta, Apple, Alphabet, are ones that are just more recently breaking out. These are not as extended as like a Netflix or an Amazon, but they're just starting to break out. And so for this bucket, I think the real question is, do they hold the breakout level, right? When you initially have a pivot point like $600 from Meta and you break above it like Meta did the first week in December, the question is, does it hold that breakout level? For now, it's looking pretty good because we're continuing to make progress, but at some point we pull back and I immediately key into that 600 level. That's where I have an alert set, and I would encourage you to think of it that way as well. With Apple, that level would be like a 235 or 236. That's the breakout level that I've highlighted. And then with the Alphabet, I'd probably use like 180, which was that gap. We gapped higher yesterday and broke above that level. And the question I was sharing was, do we follow through? Today, I would say we followed through in a big time way with a push above 195, finally eclipsing that July high. So with those 3 charts, you look at the most recent breakout level, and the question is, do we hold that? That's where I would set alerts just to see when we do pull back, do we hold that most recent breakout level? Then the final bucket are kind of the others. Microsoft, you may put in that previous bucket because it's broken above the previous swing high around 438 to 440. But I'm still looking at that July peak and seeing that looming large above current levels. Same thing I would say with Microsoft in particular. I would think of it like the previous chart we used. Look at 440 as a breakout level and see if that is able to hold. Overall, I think the breakout is strong. I think the follow through is good. And I would say most likely we retest the July peak here. NVIDIA is really a unique chart compared to all the others. And now that we've seen those other 7 charts, you see how different this one looks. While the other ones are all kind of either in an established uptrend or have just recently broken out, this is one that has not broken out. It is in a sideways basing pattern. One of 2 things is going to happen here probably very soon. Either we break above 150, which I would say is probably a very bullish sign, or we break below 132, which is probably a very bearish sign. And one of those things will happen. It's best to be patient, to wait and see which way this chart resolves. At this point, from a technical perspective, you're not really getting a clear sign, right? The RSI is almost dead neutral around 50. We're right at the 50-day moving average. We haven't really broken down much. The sideways price action over the last 6 to 8 weeks is pretty clear. So I think you wait and see which way we break. I appreciate a lot of the questions I'm seeing come in. Thank you so much for that. And let me answer a question or two before we finish off. Let's see. Glenrick, thanks so much for watching on X. You said the percent of stocks above the 5-day is barely 40%, and rates are in line for cuts if the prints stay this cool. Yeah, so that whole idea of looking at different breadth measures, and thanks for asking about that, is a really good question. And I usually just show two breadth indicators using moving averages: the percent above their 50-day and the percent above their 200-day. And that chart that I actually didn't show it today, it is here in the Mindful Investor Live chart list. This is the one that I use the most common, which is this one. And again, there's only so many charts you can look at in one day and not drive yourself nuts. So I simplify and look at this one, which has the percent above their 200-day, which I think of as a long-term breadth measure, percent above their 50-day, which is more of a short-term breadth measure. Tony Dwyer, who I have interviewed a number of times, he retired earlier this year from the industry. Boy, I'd love to convince him to come on my podcast at some point. We'll see. But if you go back to my interviews with him on Stock Charts TV, he would often talk about the percent above their 10-day moving average, I believe, and using it in a similar way that you did. I don't have a problem with that, having a third one that's more of like a tactical breadth indicator. It's just a little too short term for me, so I don't pay as much attention to it. But if you're a swing trader, I would 100% be following something like that. Percent above their 5-day moving average, above their 10-day. Those are things that can help you identify short-term mean reversion. And what you generally want to do is be looking for, severe weakness, severe strength, and look for mean reversion. It's kind of like the stochastics indicator for price, designed with a similar kind of methodology or mentality, I would say. One more question. Mark, thanks for watching on LinkedIn. What do you see in RSI daily for a NASDAQ, the I think S&P, Russell? Right. So when we looked at the chart of the S&P, and I have a version of it here that we can use. When you're looking at the RSI, it's actually not diverging. I think that's important, right? One of the clear kind of signs that you could see in any of these places would be the S&P making new all-time highs on weaker momentum. But if you look, the momentum has actually been consistently stronger, really off of the August low. So every time we've made a new high, the RSI has pushed a little bit higher. The danger sign is that last peak where the price is making new highs and the RSI is not. We've highlighted on the show some of those bearish momentum divergences, as I would call them. We've highlighted those on some individual stocks, but I would say with the S&P, you're not really seeing that kind of divergence. Boy, you are with the Russell, though, huh? The IWM making higher highs November into December on weaker momentum. Thanks for mentioning that. I don't think I would have guessed that without looking at the chart. The NASDAQ more like the S&P. So again, I'm not surprised that that's happening now that I think about it, based on what we talked about earlier, right? The S&P, the NASDAQ, growth-oriented names that are working, given some of the Magnificent Seven charts we just reviewed, breaking out on stronger momentum. Compare that to small caps, which is much less geared towards the momentum names, the growth names, and more into value and other things, actually making weaker highs. That could be a scenario to think about, is maybe the S&P and the NASDAQ are some of the only charts not giving bearish divergences, and we see them proliferate in other places. I think that might be part of what we're seeing here. Thanks so much, Mark, for asking about that. That was a helpful exercise for sure. Folks, I want to thank you guys so much for tuning in wherever you're at. If you're joining the live stream, I appreciate you so much doing so. And if you're watching the replay on YouTube, I appreciate you as well. Don't forget to check out our latest episode of the Market Misbehavior podcast with T.G. Watkins of Simpler Trading. It was a lot of fun. He had some really good comments in there and some interesting charts to review. I'm going to be sitting down tomorrow with Frank Capillari of Cap Thesis. Frank is a really knowledgeable technical analyst and a fellow CNBC contributor. Should have some interesting things to talk about, and I'll look to get that out to you later this week. For Market Misbehavior, I'm Dave Keller. Remember, it's always a good time to own good charts. Have a good night, folks.